Hello everyone, and welcome to the June Plan Sponsor webinar entitled Key Employees and Employee Retirement Strategies, courtesy of Principal Financial Group. We certainly appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly series, and today we will be providing an educational opportunity for you as the employer of your organization's retirement plan by looking at why considering a non-qualified deferred compensation plan may be an important decision given the current economic and business climate. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we'll take some time to go through these. With that said, I'd like to introduce our guest speaker from Principal, Kirk Wolf, Regional Vice President, Non-Qualified Plans for Principal Financial Group. In this role, Kirk is responsible for assisting clients in Central California, Hawaii, Montana, Nevada, Utah, and Wyoming. Kirk has more than 15 years of experience in financial services. He assists leading advisors and their corporate clients reward key employees and accumulate more dollars for retirement on a tax-deferred basis. Kirk specializes in simplifying complex ideas and presenting them in a clear and compelling style, from plan design to concept proposal to implementation. Kirk lives with his wife and 3 children in Riverside, California. He is a graduate of Washington State University and earned the Chartered Financial Analyst designation. Kirk enjoys golf, swimming, scuba diving, doing home improvement projects, and spending time with his family. We're very excited to have Kirk here to share his knowledge of non-qualified plans and determining if a non-qualified plan is the right fit for your company. I'd really like to thank Kirk for taking the time to get on this call with that. And with that said, Kirk, I'll now turn it over to you.
Thanks, Ronnie. I appreciate that, and hopefully everybody can hear me well. That was a staggering introduction. It sounds a lot like you were reading one of the Principal Financial Group bios, which, as I was listening to you, I thought to myself, wow, that's simplifying complex ideas. Oof. What we're going to do today, and hopefully this will be of value for all of you on the phone, and I suspect that for many of you, depending upon your roles with your respective companies, you may have been exposed to non-qualified deferred compensation plans in some form or fashion in the past. And for those of you that have, we're going to cover some things I think that you probably are already somewhat familiar with. For those of you who haven't been exposed to or entertained the thought of a deferred compensation plan, this will be some new information as well. So we're going to, just in a broad scope, we're going to look at the overall environment with regard to deferred compensation plans. We're going to look at some of the compelling reasons why deferred compensation plans have come into play. We'll look at the design and structure and format of the plans. We'll look at how they impact employers and employees alike. We'll take a look at some of the informal funding and financing methods of the plans, and hopefully as we go through that, we'll generate some questions and some interest on your part that you can certainly ask of us during this call, or you can circle back with your team at Pensionmark to get further clarification. One of the issues that we're facing, and as a housekeeping issue, Ronnie and I were talking about it, normally we turn control over the presentation over to the presenter. We're having a little bit of technical difficulty, so I'm going to be asking Ronnie to move through the presentation as we discuss it. So Ronnie, if you wouldn't mind moving forward a couple of slides, then we can look at what we're doing and how we're covering it. Excellent. Hopefully all of you are seeing what I'm seeing on the what we'll cover today slide. And we're, like I said, we're going to talk about retirement trends and the impact on key employees in different ways that employers can set up benefits for those key folks. We'll look at deferred compensation plans in general and the different types of those plans. We'll look at the current market trends and then considerations for you as an employer and for the employee. Next slide. And I think what we'll also have, and forgive me for this, we're going to have a little bit of delay in between the request to move and when the slides actually transition. So bear with me as we do that. one of the issues, and this is kind of an interesting thing in the next couple of slides, we'll take a look at some of the research coming from the Employee Benefits Research Institute regarding employee mindsets with regard to their plans. And this is just looking in general, some of the research that the EBRI has come up with. And the question posed to the employees is, do you have confidence that you're going to have money saved to retire? Are you going to be able to live through retirement? And are you going to be able to do that in a manner to which you become accustomed while you've been employed? And what you see just in looking at this really quickly is that over the last several years, employee confidence in their ability to retire and retire successfully has declined dramatically. And we're in a position where people are looking and saying, I haven't saved enough, whether it's because I haven't had the ability to save or because of market movement in the last several years. I'm looking at retirement and I'm concerned that I don't have enough saved, put away, to be able to live in a manner to which I've become accustomed. Next slide. And so what that ends up doing for the employees is it puts them in a position where they start looking for other things. Now, for your rank and file employees, for people that are non-highly compensated employees, they have, through conventional retirement sources, the ability to, or the opportunity to, whether they have the ability to financially or not is an individual issue, but they have the ability to, through a 401k plan or other retirement saving sources, to set aside enough money, hopefully, to get by. And it's interesting, as you look at it, most financial planners will suggest that for an employee to retire successfully, they're going to need to be able to replace somewhere in the neighborhood of 70 to 80% of their pre-retirement income during their post-employment years. And if I'm making $70,000, $80,000 a year, the contribution caps on the 401k plan give me, as an employee, enough space to save money. For a highly compensated employee, people that are making over that highly compensated limit, that option doesn't exist for them. And as you see from this particular slide, the issue for the highly compensated employees, there's a concern, and that concern has been increasing over time, about their ability to live and to enjoy the same quality of life that they currently have. And that's sort of the environment that leads to, Ronnie, next slide please, that leads to the creation and the development of non-qualified deferred compensation plans. Obviously, some of this, and I'm going to skip through, I think I mentioned at the beginning, if I didn't, forgive me, we have a number of slides that are duplicate slides in this presentation, and they're duplicate slides for compliance reasons. We have a combination of two different presentations that we've morphed together to give you today, and some of the slides, unfortunately, as I said, are duplicates, so we can't pull them out, but hopefully it will just help further iterate the point that we're talking about with regard to these plans. When you take a look at the options that are available to employees conventionally today, and I'm not going to go into defined benefit plans, since they seem to have been moving out of favor in the marketplace for a whole host of different reasons. But you conventionally have a 401k plan, you have a profit-sharing component or profit-sharing plan, and you have deferred compensation plans. And there are pros and cons to both of those plans. 401k plan, obviously an employee makes a contribution to that. The issues are with regards to the max limits and the eligible comp limits, discrimination testing issues. You can have profit sharing or employer contribution component. The issue there obviously is that across the board, the profit sharing doesn't address individual component issues, and for many employers, when they're looking at making a contribution to a qualified plan, the issue that you're faced with, generally speaking, is that you have to play nicely with everybody. You have to make the same type of contribution across the board, and when you're an employer that has multiple thousands of employees, or even an employer that has several hundred employees, that becomes a financial consideration for the employer, and you have to look at that in your overall benefits and say, is this really something that we want to do? When that happens, employers tend to look towards other alternatives, and that's where deferred compensation plans come in. And the advantages that deferred compensation plans have, obviously, is that both the employer and the employee can make contributions. Those contributions are in excess of qualified plan limitations, and those contributions or those plans bring with them additional flexibility that you won't see in a qualified plan. Now, the downside, obviously, is that with qualified plans, you have ERISA protection, and with non-qualified plans, you don't have ERISA protection. Let's go to the next slide. This is kind of and we'll touch on this for just a real quick second. It's kind of interesting, and I mentioned before, for highly compensated employees, or for every employee, you're looking at trying to replace your pre-retirement income, your employment income, as a retiree. And in order to effectively maintain the same standard of living, you're looking at trying to replace somewhere in the neighborhood of 70 to 80% of your income stream. When you look at the limitations on qualified plans and an increasing income stream, it becomes more and more difficult for somebody who is a highly compensated employee to replace that income. And so if you drew a line from the C in the word current income at the bottom of the graph, and you drew it straight up, that's the equivalent of somebody whose income is somewhere in the neighborhood of about $150,000 a year. And what you can see is that for most people in standard employment and savings situations, they're limited in their ability to replace that 80% of their income. And they're limited by the caps that you have on qualified retirement plans. And so that creates a gap that we attempt to, and in most cases successfully, attempt to replace with non-qualified deferred compensation plans. Let's jump over to the next slide. One of the ways, and this is a tool that's available through the principal, through our partners at Pensionmark, one of the ways that employees, and this is just one of many tools in the industry, and we'll go through these next two slides fairly quickly, Ronnie, but essentially what financial advisors will do is they'll do retirement replacement ratios, looking at how much an individual is saving, both on a personal and on a plan level, and help them determine whether that's sufficient savings to meet that replacement ratio goal. Let's go to the next slide. And what we have found, and it's interesting, through a series of studies that we have done and some of our partners in the industry have done, we found that for a standard employee who's making on average $130,000 a year, if that employee is saving both in the 401k plan, and we're assuming a starting balance of $100,000 of assets in the 401k plan, and they contribute from age 45 until normal retirement age at age 65, even if they're maxing out their 401k contributions, even if you add Social Security benefits coming in, and that's assuming that Social Security benefits are going to continue to pay at those ages and at the amount that the individual is expecting to receive, they still end up with a substantial gap in their ability to plan for and save for retirement. And because of that gap, that's where the deferred compensation plans come into play for you and for your employees. Let's go to the next slide. What's interesting, though, is that when we take a look at this next slide, if you combine those, and I realize I'm kind of belaboring the point, and part of that is just in terms of wanting to make sure that people understand the value of non-qualified deferred compensation plans. But what ends up happening is that if you just add the component of a voluntary employee deferral option, and that key employee takes advantage of their prime earnings years to save money on their own into a plan like this, not even counting, if you look at the screen, you'll notice the bottom part, it says NQ defined benefit. Let's even take that off the table. And if you just have the employee's ability to defer money during their key earnings years, when you use the savings vehicle of a non-qualified deferred compensation plan, you can help, if not fully close that gap, you can at the very least add additional retirement sources of income, which help make for a much smoother retirement transition. Let's go to the next slide. When we take, and we can jump past this one as well, Ronnie, let's take a look at the different types of non-qualified deferred compensation plans. And so that we're all on the same page with regard to this, a non-qualified deferred compensation plan, and some of these are really key issues. It's an employer-sponsored plan that, from an employee perspective, allows the employee to defer money on a pre-tax basis, have that money grow in a tax-sheltered or tax-advantaged position, and only pay tax on that when that's distributed to them, whether that's during employment, which is possible in these plans, or upon separation of service and retirement. And so as you're listening to this, you realize that that sounds awfully similar to a 401k plan, and they are. From an employee perspective, I put money away pre-tax, gross tax deferred. I get to, generally speaking, pick and choose investment options for the money that I've deferred, and I don't pay tax on it until I take distribution. And so for a highly compensated or key employees, which is what these plans are specifically designed for, they're top hat plans, meaning that they're eligible only for that highly compensated employee group. And they are, by definition, discretionary and discriminatory, meaning that they're specifically for this group, and the employer can pick and choose to whom they offer this particular benefit. When a plan like this is offered, it gives the key employee tremendous flexibility in terms of being able to make up that gap. Let's jump to the next slide. Interestingly enough, if we look back since 1995, these are not uncommon plans. Now, they may be unique to those of you that are on the phone. You may not have had much experience with regard to them. But these are plans that even through the market downturn that we saw over the last 3.5 years, they're plans that have been adopted across the board by all levels of employers. And they've been adopted for not just the C-suite employees, but also for key employees, high-performing employees. And they've provided a way for an employer to say, you know what, I want to provide a benefit for my best folks. I want to provide a benefit for those people that are key to my organization, but I'm not in a position to provide a benefit universally across the board. And if I did, the financial impact of that would be staggering. And so I want to just focus on this key group of people that are essential to the performance of my company, and that's what the deferred compensation plan allows. Let's jump to the next slide, and we can take a look at the size and type of employers that have been adopting these plans. And so obviously, as you would suspect, Fortune 100, Fortune 500, Fortune 1000 firms are certainly going to be utilizing plans like this. And on average, you look at somewhere in the neighborhood of 69 to 75% of companies in that sphere have adopted non-qualified deferred compensation plans in some form or fashion. And that you would expect to see that larger companies offering increased benefits. But what's interesting to see is that smaller companies, and I'm dropping all the way down to the sub 1,000, so you're looking at anything above 500 employees and beyond, and it's the anomaly of that 1,000 to 2,500 employee firm size is kind of an interesting one, and it's just a function of that area of the marketplace not being aggressively marketed to, quite frankly, from firms that do what Principal does. But you see a large number of firms that are like many of you that are on the phone right now, utilizing non-qualified plans, and they utilize them to provide a unique and special benefit for their key folks. What's interesting, though, is that even smaller companies, companies that from 1 to 500 employees, are utilizing non-qualified deferred compensation plans. And from Principal's perspective, our fastest growing segment of our market is the 100 to 1,000 employee firms. That's where we see the biggest increase in the number of companies that are coming to us and saying, hey, let's take a look at this and see, is this a benefit that I can provide to my key employees? Is this a benefit that I can offer to the people that matter to us? And is this a benefit that we can do in a cost-effective manner? And so that's part of what we end up doing, working with folks like Pensionmark to work with you as an employer to see, does this fit? Is this a solution that can solve some of the problems that you have? Let's jump to the next slide. Now, what's interesting about this is that where we see the growth, if you look on the right-hand side over the next 12 months, there's a number of different surveys, and they reference it down at the bottom. There's Profit Sharing Council of America, Boston Research, and then a number of other firms that have done and continue to do market research with regard to non-qualified deferred compensation plans, both their uses, their prevalence, and how companies are changing how they use these plans to benefit their key folks. And we're going to talk about that in a little bit, because these plans are, if I would use a single word, they are flexible. They're infinitely flexible in terms of being able to be molded to fit the needs of a particular employee group and a particular employer, and provide a benefit for both the employees and the employer that you can't find really in any other sphere of our industry. Let's jump to the next slide. Now, we're looking at how plan sponsors and plan participants utilize these plans. Obviously, a plan like this it fits what we call the 4 R's: recruiting, rewarding, retaining, and retiring key employees. It helps fill the gap that we looked at earlier. And most of the time when employers are pulling into or pulling a plan like this into place, they're doing it because they want to help their key folks save for retirement. But there's also an increasing segment of the marketplace that says, you know what, we want to figure out a way to hold on to our best folks. And we want to figure out a way that we can do it that's both beneficial for them and beneficial for us as an employer. And while traditionally you would look at increased compensation just directly, I'm going to increase somebody's salary, I'm going to increase their benefits from that perspective. The downside of that obviously is that there's little or no flexibility from an employer perspective. Once I've increased somebody's base salary, I've increased their base salary, and that has a snowball effect on all of the other benefits and all of the other employee costs. Whereas when employers use deferred compensation plans, they can pick and choose how they provide benefit, and it becomes a strategic implementation for an employer to provide a benefit for the key folks. From a participant perspective, obviously the biggest aspect is being able to save money. And I'm going to mention this, although I'm sure all of us on the phone are well aware of this. When I save money on a pre-tax basis, it's infinitely better than when I save money on an after-tax basis. I have more money working for me sooner, and even if I assume that my tax bracket doesn't dramatically decline in retirement, having the ability to have the compounded growth of pre-tax savings is going to give me a tremendous benefit even into retirement. And what we're finding is that the ability to have or the opportunity to have a deferred compensation plan is a huge issue for employees that have experienced them in the past. I was just meeting with an employer yesterday, and they have a number of key folks that have come over to their firm, and because these individuals have experienced and been involved in deferred compensation plans in the past, that was the first thing that they asked for. They said, let's have this as well with this employer. And so what you'll find is that it becomes a tool for recruiting people, and it also becomes a benefit that your highly compensated employees, if they've experienced it before, will value tremendously. Let's jump to the next one. Now, in non-qualified deferred compensation plans, there are a number of different components, and I'm only going to touch on a couple of them today. You have for-profit companies and not-for-profit companies. For-profit companies, a defined contribution is what Principal calls an excess plan. They're 409A contribution, employee contribution type plans. Now, there can also be an employer contribution component, but just for ease of use, we call that our excess plan. You can also have, for-profit companies, a non-qualified defined benefit plan. And there are many advantages to the non-qualified defined benefit plan that you don't see in qualified plan DBs. However, and I will tell you this just from a market-based perspective, they are less common, just like qualified plans. The qualified defined benefit plans are becoming less and less common in the industry. And if you're a not-for-profit company, you have really two different avenues to travel. You can look at a 457B or a 457F plan, and the 457F plan is also used as a defined benefit component for not-for-profit companies. I'm not going to spend any time talking about those today, but if you have interest in that, reach out to the folks at Pensionmark, and they can certainly provide you with information on that. Let's jump to the next one. The non-qualified defined benefit plan, and I touched on this just a second ago. Essentially what the employer is doing is saying, I'm going to figure out some sort of benefit for my key employees, and I have the flexibility with this plan to either fund or not fund, depending upon my corporate financial situation at any given point in time, which, as you might imagine, provides a dramatic benefit over a qualified plan, which has very strict funding requirements and oftentimes makes it untenable for an employer. With a non-qual DB plan, you can pick and choose to whom you provide the benefit. You can pick and choose a varying benefit for each individual, and you can pick and choose how you set aside the funding or the financing for that particular obligation. So there's flexibility incumbent upon that. I see that, generally speaking, applied to the C-suite of employees. I don't see that moving further down market, but I am sure that there will be changes to that and changes to how employers look at that as they become more and more familiar with it. Next slide. The excess plan, this is what I was just talking about a minute ago, and you'll notice as we go through this, I'm going to be reiterating a couple of points with regard to it, regard to non-qualified deferred compensation plans. And from an overall perspective, from the IRS's standpoint, a non-qualified plan is an unfunded, unsecured liability of the corporation. It's an obligation to pay their key employees some benefit at some point in time. And so if you oversimplify it, it's an agreement between an employee and their employer, the plan sponsor, where the employee says, don't pay me this money today, hold on to it for me, let me invest it, or I'm going to pick and choose how you invest that, and there's ways that that works. Have that earn some sort of crediting rate for me over time, and then pay it to me at a point that I pre-select in the future. That's as simple as these plans get. Now, they have to follow 409A regulations in terms of their design and their scope and how the plan is administered, but that's at the core of the plan. And because of that, it avoids all of the restrictions you see on the qualified plan. You could theoretically design a plan that allows for up to 100% of compensation to be deferred for a particular employee. And so there's a tremendous advantage. Obviously, if they have to live, they would want to bring some of that compensation on a daily basis. But it allows the executive, that key employee, the ability to say, I'm in my prime earnings years. Maybe, knock on wood, my kids have left, they've gone to college, they've graduated from college, and so I have a period of time where I'd like to save as much money as I can for retirement. And that gives them the opportunity and the ability to do that on a pre-tax basis. Combined with, the employer has the ability and the discretion to make employer contributions as well. And so it allows the employee and the employer to come together and create a benefit that provides for the needs of the employee, and it also provides a benefit for the employer as well in terms of solving problems for their key folks and increasing the retention and their ability to specifically reward key employee behavior. Let's jump to the next slide. When looking at a plan, when looking at a deferred compensation plan, and these 8 issues, these 8 plan design considerations are not the only things that we have to think about, but they're the key issues that have to be considered in setting up and designing a plan. And this also speaks to the flexibility component that I mentioned just a minute ago. In a plan like this, the employer has flexibility in terms of designing the plan. And so each non-qualified deferred compensation plan is in and of itself, within the framework of 409A, unique for a particular employer. And so, for example, you look at the eligibility. You can look at your entire employee population, take your key employees, your top hat employees, and make them eligible for a plan like this. Or you can say, I'm going to limit it to just these 5 or 10 or 15 employees, and I'm not going to offer it to everybody. Then you look at the compensation and the contributions. I can specifically allow my employees to contribute to the plan, and I can allow them to contribute out of salary and bonuses and special bonuses and performance-related compensation, or I can limit that, and I can say, I'm only going to allow you to contribute out of your bonuses, and I'm only going to allow you to contribute a small percentage of your bonus. So there's flexibility from the employer's perspective in terms of what they allow going into the plan from the employee side. Plan contributions from an employer side, though, have tremendous flexibility. As I mentioned before, they're discriminatory and discretionary. And so an employer can pick and choose for whom they offer the benefit and for whom they make, if they choose to, contributions, and what type and style of contributions. And so it may be, as I was speaking with an employer yesterday, where they are offering one type of matching contribution for their C-suite employees, and they're offering a different type of matching for their second-tier VP level. And then for the highly compensated employees who are not part of the executive management group, they're offering them the ability to participate in the plan, but they're not making any employer contribution. The earnings crediting just talks about how we offer the employees the ability to pick and choose deemed investments and how the employer holds the asset. Vesting schedule. Unlike qualified plans, the vesting components are infinite. An employer can pick and choose any number of different vesting schedules, and they can have different vesting schedules for different type of contribution. They can have different vesting schedules for different employees that are receiving an employer contribution. And the vesting can be tied to time, as you would normally see, like, for example, in a qualified plan, a 5-year vesting schedule based on your eligibility to participate in the plan or your employment date, or it can be something that's a little bit more complex. You can have vesting schedules tied to each contribution that the employer makes into the plan. And those are what we generally refer to as rolling vesting. And for example, if I made a contribution today for my employees, and that contribution had a 3-year rolling vesting schedule, then it would, over the next 3 years, fully vest for the employee. Then next year, when I make a contribution, it starts a new vesting schedule for that bucket of money. And so what that does, as you can obviously see very quickly, it allows you to retain that golden handcuff component for your key employees. The other 3 aspects, the benefit payment events, the benefit payment options, and the security mechanisms, they reference when do I get the money and how do I get the money. And unlike qualified plans, you're not tied into age 59.5 or age 70.5 required distribution components. The employee and the plan can be designed to allow employees to take distributions as soon as they separate service. There are no penalties. You just pay ordinary income tax like you would a 401k distribution. There are no penalties for early withdrawal. And you can allow the employees to potentially take distributions while they're still employed. And we'll talk about that in a second, how that provides a really unique benefit from a deferred compensation plan for a key group of employees. The benefit payment options, just like you would see in a 401k plan, you can take distributions either in lump sum or payments over time. The issue that you face, however, is that the employee has to pre-elect with each contribution how they want to take the money. And so that adds a level of complexity. It's certainly not an overwhelming one, but it adds a level of complexity for the employee to consider as they're looking at taking distribution. But you end up having the same level of flexibility. I could theoretically, if the plan allowed it, take payments over the next 15 years while I'm retired. And so it allows the employee to plan for their retirement needs. From a security mechanism standpoint, we generally utilize both change of control provisions and rabbi trusts to provide an additional level of security for the employee, keeping in mind that in the event of corporate insolvency, then the bankruptcy courts involved in that insolvency proceedings would rule on the distribution of the asset. And so the danger or the risk to the employee is potentially, if my employer goes into insolvency, I have the risk of all or a portion or some forfeiture of those assets as we go through the bankruptcy proceedings. And we'll talk about that as we go through it as well. So if we'll jump to the next slide. And the next couple of slides we'll move through fairly quickly, but it's interesting to see as you look at how plans are set up right now, among highly compensated employees, generally you're seeing almost 10% of salary and 15% of non-salary deferrals, and that's across the board with regard to the plans that are administered principal and the plan information that came out of the Boston Research Group study. And just so you know, if you're not familiar with the Principal Financial Group, we are among the leaders in the country in providing non-qualified deferred compensation plans, and we do that for all employers, very small employers, 50, 100 employees, up to the Fortune 100 firms. And so we have a broad spectrum and experience with regard to it. It's a key component of Principal's business. And so it's something that we do better than everybody else, and we pride ourselves in our ability to make a plan like this fit the needs of an employer and employee group. Let's jump to the next slide. And forgive me for that shameless Principal plug. I didn't necessarily mean it to come out that way. Qualified plan limitations, and this is, the title of the slide, Why Key Employees Need Help. It's interesting, in talking with some of the companies that have implemented plans in the past, it differs depending upon the state that you're in. In California, the concept of having the ability to save excess compensation is really dependent upon your overall income being in excess of $150,000 to $200,000 a year. In other parts of the country, somebody who's making $120,000 a year may be in a position to have excess retirement savings. But if you take a look at this, with qualified plan limits in 2012, and taking somebody that's compensated in, and actually I'm looking at the wrong slide. If you would jump to the next slide. This is the slide I was thinking of. If you take a highly compensated employee who's making about $400,000 in compensation, if they're participating in their 401k plan, and this is assuming that they have the ability to contribute up to their 6% limitation based on the non-HCE contributions, they're putting away about $15,000 into the 401k from an employee perspective. You have an employer match component that's going into it, and you have a profit sharing component. So it's fairly reflective of many of the plans that we see. If you take a look at that, the employee is saving just over 5% of their overall compensation. And so you think about it, somebody who's in that highly compensated position isn't able to effectively save on a pre-tax basis. And so in effect, the rules with regard to the qualified plan sort of discriminate against that individual's ability to save, and that's where non-qualified plans come into play. Let's jump to the next slide. Let me give you an example about how a plan works from a functional standpoint to benefit an employee. And in this case, we're taking a hypothetical employee that's making $150,000 in base salary and potential for bonus up to another $100,000. And that employee says, you know what, I need my base salary to live on, so I'm only going to defer a small portion of that, but I'm going to defer more from my variable income, from my bonus stream. I've got kids, I want to save for college, I'd like to buy a second home, and I'd like to fund my retirement. Those are all fairly straightforward. And by the way, from my own perspective, I have 3 kids that I'm saving for college, and I do it in principal's deferred compensation plan. And so what ends up happening, the individual's looking, saying, I have needs, financial needs that are going to come to me while I'm still working. I have a desire to do something that will impact me while I'm still employed, and then I have retirement savings. And utilizing a deferred compensation plan, it allows this particular individual the ability to save an additional $65,000 pre-tax that they wouldn't have been able to do otherwise. And because of the nature and the flexibility of the plans, you have savings for one child's college funding, and if you'll notice down at the bottom, it shows that coming out in 4 payments. With each of the distribution schedules that are set up, the individual has the flexibility of picking how that comes to them. So this particular employee is saving for their daughter's college, they're saving for their son's college, and they're going to receive those payments while they're still working. They're planning for a future financial need that they know that they're going to have. And of course, you could save money on an after-tax basis, but now instead of putting away $65,000, it's after the tax wash, so I've got about 55 to 60% of that money being invested for me. So there's a substantial difference in terms of its ability to compound. You're also planning on saving for a beach house, and so putting away money every single year for that. That's going to come to the individual in 2022, and the remaining amount is for retirement. And the retirement, that's a non-date specific time in the future when you're going to be separating employment service. And so the point of this is that you can design a plan for your key employees that allows them to meet and cover all sorts of financial needs and requirements that we face throughout our employment life. Let's jump ahead. I realize just looking at this that we're on slide 26, and I think in this presentation we've got about 40 slides, and we've got about 15 minutes left to go with regard to this. So we're going to go through some of these a little bit faster, and hopefully we will still be able to cover some of the things that you need to see with regard to it. Trends that we see in the marketplace today, essentially what we're seeing is that employers are designing the plan specifically for the needs of the employees that they have. It's not a one-size-fits-all situation. It's where the employer is looking and saying, I've got this particular group of employees that I'd like to provide a benefit for, so let's design the plan that's going to be good for them and good for me. The approach to the investments, I'm going to touch on that in just a second. That's kind of a key differential between how plans are designed today and how they were designed in the past. So let's jump forward. It's an interesting sort of a shift in the marketplace. In the past, the plans were unbelievably simplified, meaning that you defer, your employer gives you some sort of crediting rate, you take the money when you separate service, that's it. With 409A, the plans have become significantly more flexible in terms of their design, and so we saw a movement in the industry to providing all sorts of crazy flexibility in terms of the plan, the way we built the plans. And what we're seeing today is that employers are saying, okay, that's great, I have tremendous flexibility, but let me solve this problem first. I have key employees that I'm unable to retain. I can't compete from a salary standpoint. How can I hold on to these people? And so providing a golden handcuff component, employer contribution, is a real easy way to do it. And so what we do is work through Pensionmark and with you to help design the plan that's going to meet the particular needs that you and your employees have today, leaving enough room to amend and to build on additional flexibility components of the plan to meet the needs that you and your employees have as as your company grows and as your lifestyle and circumstances change. The other aspect that we see is that there's an increased focus on education. You know, if you build it and nobody comes, if I offer a benefit and nobody really views it as such, then I've just wasted a tremendous amount of time and effort. What we do today is we spend a tremendous amount of time educating the employees, your key executive, as to what this plan is so that they recognize that you as the employer are offering them a tremendous tool to help plan for, as we mentioned before, financial needs that you have while you're working and your post-employment life. Let's jump forward. I mentioned at the beginning that we use it to recruit, retain, reward, and retire. Those next three bullet points are really the three most common uses for deferred compensation plan. 401k repair. This is the most common issue that I hear. My key folks are getting refunds. My key folks aren't able to save enough. My key folks fill in the blank. With a non-qualified deferred compensation plan, you can fix that problem, and it's an easy fix. I just met with the company last week. They're a fairly large restaurant chain. And the issue that you might imagine, they have a huge number of employees that are non-highly compensated and have no interest in participating in a 401k plan. And so as a result, they're highly compensated. Their key employees, their management employees, are limited to less than 1% of their compensation as a deferral into the 401k plan, which really kind of eliminates it as a benefit for them. We came in and proposed a deferred compensation plan, so it's going to act like a 401k plan for those key employees. Solves their problem, and it does it in a timely, cost-efficient, effective manner, and it's customized for the needs of that particular employer. I've got employees that need to, not just want to, but need to, as they face retirement, they need to save more than $17,500, and even if you assume an employer contribution, they're looking and saying, I've got to sock away more money. And a plan like this allows contributions in excess of 401k limits. Then you also have what we were just looking at before. I'm getting compensation today. I'd like to avoid taxes on it. I know I'm going to need it 4, 5, 6 years from now. And so it allows you to tax plan how you receive this particular money and when you receive it, and you can time that towards specific needs that you have as an employee. Let's jump forward. Now, with regard to a deferred compensation plan, as I mentioned before, a non-qualified plan is an unfunded and unsecured obligation or liability of the company. Essentially, the company is saying, you defer this income, we're going to hold it for you, and we're going to pay it to you at some point in the future. And from the IRS's perspective, the plan itself is the liability. It's just the promise to pay a benefit at some point in the future. Now, an employer is faced in with the decision. Do they set aside a sinking fund of assets so that they have liquidity to meet that future need or not? In the past, Fortune 100, Fortune 1000 firms generally kind of move towards not setting aside a sinking fund because the amount of that future liability was statistically insignificant relative to the company's overall cash flow. Most of us, that's not how we work. Most of us, if we have this bill that we know that's coming, we're going to try and set aside money for that. And that's what happens for the vast majority of the companies that we work with. They set aside a sinking fund, a pool of assets to meet this future obligation. And as the slide mentions, the companies can set aside that sinking fund in a number of different ways. They can hold it in taxable investments that are owned by the company, or they can hold it in tax-sheltered corporate-owned life insurance that's also owned by the company. And the direction that they choose, and quite frankly, Principal is agnostic with regard to any of those three methods. We support all three, and we work with the companies that utilize all three. It's really a financial decision for a company. A, do I offer a plan? And if I do, am I going to set aside a sinking fund of assets so I have liquidity to pay my future obligation? If I set aside that liquidity, what's the best way to do it? And that just becomes a financial analysis based on some of the information you see on the right-hand box there. Let's jump to the next slide. There are pros and cons to both. What we generally see companies that I mentioned before, very large employers where it's an employer contribution only, and that's really more of a psychological issue, and when the company has large cash flow, so it's really inconsequential for them. For companies that set aside money, if they are low tax-paying entities, then any growth on this investment isn't going to have a negative impact on them. Or if they're looking at a relatively short time horizon for the plan, then using taxable mutual funds to hold the asset generally makes much more sense. For companies that are in a higher tax bracket, by that I mean federal and state combined over 40%. If they're in a higher tax bracket, and if the company is looking at trying to improve their P&L, or if the company has cash flow requirements where paying taxes on an ongoing basis on the growth of an asset isn't desirable, then corporate-owned life insurance can make more sense. Let's jump forward. Just as an ancillary look, if you look at for-profit clients of the principal, 7% choose to not set aside any financing, 28% utilize taxable investments, and 66% use corporate life insurance. And some companies use a combination of all three. And so the point behind that is that we support all of those methods, and it's really going to be what's in the best interest of the company from a financial perspective. That's what leads to this decision. And generally speaking, just so in case the question comes up or you're thinking about it, why so many companies using corporate-owned life insurance, it's because companies that look at adding a plan like this are generally profitable. Companies that look at adding a plan like this are usually in a higher tax bracket. When they offer a plan like this, it's usually not just for one or two people for the next couple of years. Most of the time, companies say, we're going to add this as a benefit for our executive team, and when we have new executive team members, they're going to participate as well. And we're going to use this as a permanent piece or a long-standing piece of what we offer to our employees. And so it tends to lead itself more towards that side of the equation. Let's go to the next slide. 409A regulations. We're not going to spend any time on this, but just so that you know, let's go to the next slide. 409A regulations are and next slide. 409A regulations govern deferred compensation plans. 409A regulations were passed in 2005. They were enacted where all plans have to comply with 409A as of 1/1/2009. What Principal does is helps the employer design and create a plan that complies with 409A regulations, and we monitor that with you to make sure that the plan stays in compliance with those regulations. And they're very straightforward, and we can talk about that at another time. Again, this is replicating some of the other information before. It's an unfunded and unsecured obligation of the company. It's a liability with an offsetting sinking fund that's been set aside. Jump to the next. Let's go. We'll skip this one too. This is actually kind of an interesting, whoops, we'll stick on this slide for just a second. If you were listening to me before and you're thinking to yourself, okay, wait a minute, there's a liability, but you don't have to set aside an asset. I'm not really understanding the concept here. Think about it this way. The plan itself, what I offer to my employees, the benefit I offer to my employees, it's a liability. It's the deferred compensation plan liability. Then I am, as a company, choosing to set aside an asset, a sinking fund, to meet that liability. I don't have to. I could pay my liability out whenever people retire. I could pay that out of corporate cash flow. It may be that my operating cash flow is sufficient on an ongoing basis to meet that obligation and pay out my employees. And so the corporate asset that's set aside is just one method of potentially paying out that liability. Most companies, as I mentioned before, just out of sound financial governance, will set aside a liquidity pool or a sinking fund. And that's what we help you decide as an individual company. Is this the right thing for us to do? And if so, what's the best way for us to do it? Let's jump forward. Jump again, because I think I belabored that particular point long enough. Here's an interesting thing. People ask me, if I have taxable investments, just mutual funds, and I have corporate-owned life insurance, how do those actually work? You know, I don't understand. I've bought life insurance before, and I don't like it, and you know, I'm distrustful of life insurance, which is kind of a standard response for most people. Here's how it ends up working. Two different options available for the company. If they set up, I'm offering my employees this deferred compensation plan, and I'm giving them, on the liability side, 25 different mutual funds to choose from. And those mutual funds we're tracking from an investment perspective that either increases or decreases the liability owed to the employee, just like the 401k plan. I put $50,000 into these 5 mutual funds, and it grows by 10%. Now I have $55,000. The same thing applies with the deferred compensation plan. You're crediting them the growth of those mutual funds. And then the company is holding an asset, and the company can hold that asset in any form or fashion that they would like. Most of the time, companies will say, well, if I'm offering my employees these investments, I'm going to take the actual money and put it in those investments too. That way, if the employee's liability account goes up, the asset goes up. If it goes down, it goes down. I don't really care, just so long as I have sufficient sinking fund to meet my obligation. And when I do that, if I put it into taxable investments, you can see how that process works. Or if I put it in corporate life insurance, you can see how that process works. And as I mentioned before, the method that a company uses is entirely dependent upon what makes the most financial sense for them. Let's jump to the next one. Keep going. Okay. The question that often comes up as we talk about these plans is, okay, that sounds good. I'd like to hear more. And recognizing we are covering a vast amount of information in a relatively short time period, I want to learn more. I want to understand more about these plans. Question number one is, how does this work in conjunction with my existing 401k plan or the qualified plan benefits that I offer? What's interesting to note is that a deferred compensation plan deferral on the employee's part reduces their gross income right off the top. They're electing not to receive it. So if I'm making, for example, $150,000 a year and I defer $25,000, then my income that I am choosing to make my 401k deferral from is now $125,000 because I've said in advance, don't pay me this money, so it's not part of my calculation. And so the non-qual plan money is deferred first, and then the employee can make their election with regards to the deferred or to their 401k plan. Keeping in mind that the amount of money deferred, they don't offset each other. There's not a combination max deferral amount. They're separate entities. What Principal does is they work with you and with your key employees to decide what's an appropriate amount for me to save, recognizing all of this is stemming from the fact that I, as a key employee, need to save more. I'm approaching retirement at some point in my life, and I want to set aside more money, and that's sort of the genesis for all of this. When you have a qualified plan and a non-qualified plan, if they're with the same provider, Principal will support it when you have a 401k plan with us, and if you don't have a 401k plan with us, the participants receive statements just like they would on a 401k plan on a quarterly basis. They have the ability to access their account online to make changes with regard to it. From a plan administrator perspective, you get the same information you would on a 401k plan, but actually you get a little bit more in terms of how the plan operates and your ability to affect the operation of the plan. Next slide. Keep going. I'll kind of touch on this. I think this sort of reiterates much of what we've talked about. For an employer, it helps you solve a problem. If you don't have any problems, if all of your employees are saving as much as they want, if they're thrilled with their benefits and their compensation, if you're not losing key people, if you're not having a difficulty attracting key folks, if all is good, then there may not be a need to consider a deferred compensation plan. If you are looking at ways of creatively benefiting your best people, then a deferred compensation plan may be something to consider. And if you have any of the other problems, if we're failing our testing or we're not comfortable with our safe harbor or our employees are maxing out but that's still not enough, that's where a deferred compensation plan comes in. And because the employer has the ability to apply this to whomever and however they would like to among their key employee group, it's tremendously flexible for you as an employer. You can target behaviors that you want to have happen. A company that I met with earlier this week, they were looking at a vesting schedule and a contribution schedule that was tied to corporate EBITDA. Kind of a creative way of approaching it, but the key executives are benefited and bonused based on the corporate performance to their EBITDA goals. And the company is going to be making contributions based on both the attainment of the goal and then they vest in their contribution, or that they vest in that money in future years based on the company's ability to continue to hit those goals. And so it's not even tied to a time-based vesting schedule. It's based on a performance-based vesting schedule. So I mentioned that simply because there's tremendous flexibility as you look at ways to provide a benefit that benefits the employee and benefits the employer. The assets that are held in the plan to informally finance or fund this obligation, they remain as assets of the corporation. Unlike a 401k plan, if I make a contribution for you and you leave with an unvested amount, that stays within the plan to offset future contributions, costs, etc. In a non-qualified plan, if I make a $100,000 contribution for you and you leave and you're only 20% vested, that other $80,000 is an asset of the corporation. I retain it, and I can do whatever I would like to with it. I can use that money to provide a benefit for your replacement. And so what that does for the employer is it gives them tremendous benefits in terms of being able to control what's being offered and how they give it to their employees. Jump to the next slide. The issue that an employer has to consider, and this goes back to my comment at the very beginning about cash flow, the issue that an employer has to consider is the cost of the plan, the administration of the plan. Those fees are extremely competitive, relatively inexpensive, any other euphemism that you can think of. It doesn't cost a whole heck of a lot to administer a plan like this, generally speaking, and any cost associated with the administration is deductible. The issue that employers face is the deferred versus the current income tax deduction. If I pay you today $100,000 in compensation, I'm expensing that today, and it provides an immediate deduction for me as a company. If I'm not paying it to you, if you're deferring it and I'm holding on to it for you, I don't get that deduction today. I'll get it at some point when I pay the money out to you. But the issue that a company has to be comfortable with, and this is why generally smaller companies don't offer deferred compensation plans, because a small company is generally speaking going to be hyper cash flow sensitive. They're living and breathing and dying by each deduction. And so if you are in that position, this plan may not be an appropriate vehicle for you. But if you are not hyper cash flow sensitive, then a plan like this can provide a tremendous benefit, because I haven't lost my tax deduction, I just delayed receipt of it. And so in that example, let's assume a 40% tax bracket. If I pay you $100,000 today, I get a $40,000 corporate deduction. If I don't pay it to you, I'm holding onto the money, I didn't get the deduction today. But let's say that $100,000 grows to be $150,000, and then you retire and I pay it out to you, I'm getting a deduction on the amount that I distribute. And so I'm delaying receipt of a smaller deduction and receiving a larger deduction in the future. And that timing differential can provide a benefit for the employer and a leverage for the employer. Next slide. Future of non-qual plans. It's interesting, even through the market downturn, as you probably surmised from the earlier slide, companies were coming to deferred compensation plans in droves. Not all of them adopting them because, quite frankly, it's not an appropriate vehicle for every employer. But we have had, in the last 5 years, a tremendous number of companies of all sizes looking at deferred compensation plans and trying to figure out how it can provide a benefit. And in addition, companies that have deferred compensation plans, or that have had them in the past and they're still on their books, have come to us asking, would you help us look at this benefit to see if it's doing what it's supposed to be doing? And am I paying the right amount in fees? Am I getting the best benefit? And do my employees perceive it as a benefit? And so the need for plans like this is increasing as current tax rates increase, and as your key executives are losing opportunities to defer money on a pre-tax basis. Plans like this are increasing in value both for the company and for the key executives, and they become an increasingly valuable tool for you to creatively provide benefits for your key folks. Next slide. Now, I apologize to all of you. I think we went a couple of minutes over, but we started a few minutes behind, so hopefully it all worked out, and hopefully the issues with regard to me having Ronnie do the slides didn't create too much of discord for you. I appreciate everybody's time, and I think now if you have questions, you can certainly either email them or pass them on to Ronnie and the team at Pensionmark.
Yes, thank you, Kirk. Just wanted to address the Q&A. We will in the essence of time, we'll only ask a couple questions. But if you do have any additional questions, please feel free to reach out to your dedicated relationship manager here at Pensionmark, and we'll get those questions answered for you. And for the first question, and I'm glad someone brought this up, I just wanted to address, the question was asked if slides will be available after the webinar. We are recording the webinar, and that will be posted on our Education Center on our new website when that is up, and that will be up shortly. And we will also work on getting these slides out to everyone who was in attendance after the webinar. For the first question, Kirk, someone had asked if you could expand on the method of using a combined funding methods between
Sure.
the unfinanced COLI and taxable investments.
You bet. I'll give some real-life examples with regard to it. Generally speaking, it's not a one-size-fits-all situation. You may be setting up a plan today, and you have some people that are going to retire in the next couple of years, and other people that are, they have a longer time horizon. And as we add people to the plan, as new executives join the firm, that time horizon gets pushed out. But generally, when a plan is started, you have relatively short time horizons for some people. And because of the nature of life insurance from an investment perspective, and just for clarification, corporate-owned life insurance, in this case, they're institutionally priced and institutionally designed policies that you can't buy from a retail perspective. And as a result, their cash flow accumulation is extremely efficient and their internal costs are low. However, with that being said, if you put money into a life insurance policy today and you take it out tomorrow, generally speaking, that's not the wisest choice from an investment perspective. It needs to have a chance to compound on a pre-tax basis and have compounded growth. And so that's usually the situation where we'll see people use a dual funding perspective, where they'll say, okay, I'm using corporate life insurance because at its core, it's just a tax-sheltered corporate asset. Nothing more, nothing less, that provides some form of death benefit or cost recovery. And so I'm going to put a portion of the money into that because we have a longer-term time horizon, but I'm also going to save some of that money in just taxable investments, straight mutual funds that I'm holding, because I know that Bill and Pete are going to be retiring in 2 years and I'm going to need to pay them out. That's usually the method in which people approach it. Another method is that companies will come to me and say, you know what, right now we have a whole bunch of NOLs, carry forward, and we're not paying taxes, so does it make sense to use corporate life insurance? Why don't we start with taxable mutual funds since we're not paying taxes right now anyway, and we'll save a little bit on internal costs and we'll see how it goes. Almost always, and if you look back at the percentage of clients the principal has, when somebody starts with just taxable investments or a combination thereof, they tend to morph over time where the majority of the assets are held in tax shelter in the corporate life insurance perspective because it makes more sense over time. Does that answer the question, hopefully?
Great, thank you, Kirk. The next question, and this will be the last one, and we'll follow up with any additional questions that anyone might have. But Kirk, could you expand on maybe the typical process and time frame for implementing a non-qualified plan for a company?
Yeah, you bet. And forgive me, I didn't even address that as we went through this. Generally speaking, what ends up happening is that the company reaches out through their advisor with regard to a problem or an issue that they're facing, and we had talked about a number of them. We sit down with you and with your Pensionmark advisors and say, okay, let's talk about this. What is it that what are you trying to solve? When we determine what that is, and maybe it's just as simple as a 401k replacement plan, then from start to finish, the process generally takes somewhere between 8 weeks and 12 weeks. And that's because each plan is custom designed in and of itself. We design the service agreements, we design the plan agreements, we design the plan documents, all of that based on the particular needs of the individual employer. And that requires interaction between finance and human resources and your internal or external counsel and the principal. And I've had plans that have implemented as quickly as 4 weeks, and I've had plans that have been a little bit longer. extending 6 months just because of the timing in the decision-making process. I think what's most valuable, though, is to keep in mind that each plan is going to be specifically structured for the needs of that individual company. And the other thing that I would mention is that I have a number of companies that come to us and say, we think we need or want a deferred compensation plan. And after we have a chance to take a look at this, and this is where the consultative side comes in, it may be that there are other benefits that are more appropriate for that company that will solve their particular problem. And that's also what happens in the first part of that process.
Great. Thank you, Kirk. Like I said, if anyone has any additional questions or would like to discuss in further detail if a non-qualified plan may be a right fit for your company, please feel free to reach out to your dedicated relationship manager here at Pensionmark. I'd like to thank all of you for taking the time out of your busy schedules to listen in today. And once again, Kirk, thank you for getting on the call and presenting.
You bet. Have a great day.
You too. Please join us next month where we will be hosting the quarterly guide to the markets and economy. This now concludes our webinar. Thank you.